Typical, isn't it? Typical. They move the furniture and then I have to put it back afterwards. Well, we'll do it later. Listen, it'll come as absolutely no surprise to you that we are now running seriously behind time. Having been on Sapoa time, we're now back to Africa time. I always promised you brief introductions, but this next panel is crucial because this is the panel when we're going to really discuss the industry. And to give us some insights and to put it into perspective, Patrick Sumner is with us. He's the head of global property for Henderson. He's had decades in the business. I'm not being disrespectful, that's a compliment. No, come on. And numerous degrees from extremely prestigious organizations and institutions such as Oxford and the London Business School. We are delighted to have you, sir. Should we say 25?
25.
25.
I'll take my watch off and put it on here. Good morning, ladies and gentlemen. Thank you very much, Richard. In the interest of time, as Richard said, I'm going to focus not on the broad topic that's in your program, but just on Europe. You might say that I could deal with Europe in about 2 minutes flat. But no, really, there are some interesting things to say about parts of Europe today. No one's told me how to work this. So push the big green one. Here we go. And how do I go back? Right, okay. I didn't practice, you see, I'm afraid. This basically gives you a snapshot of what Europe looks like today. 86 stocks in the benchmark, and when I talk about the benchmark, I talk about something called the FTSE EPRA Nareit Developed Europe Index. It doesn't include some of the Eastern European countries. It doesn't include many of the Southern European countries anymore. The UK is one-third, sorry. France, we actually operate an index in which any stock is capped at 10%. But in this particular occasion, I've kept the one stock that would be affected, Unibail-Rodamco in France, at its full market cap. So France is a bit bigger than it would otherwise be. Germany has sort of risen quite sharply. It was the best performing market last year, which for reasons I don't quite understand. Switzerland, Sweden, Netherlands, etc. The other countries, I think, include one in Greece, Finland, there must be something in Norway, and I've probably forgot Italy. Okay, moving swiftly on. Performance. I always say that the sector, generally, and I'm talking about the global sector here, should return between 10 and 12% a year in the long run. It'll never be a straight line because stock markets get in the way, macroeconomics get in the way. But the reason I come to that 10 to 12% conclusion is that if you start with direct property, expected returns in the developed countries for unleveraged core investment property, 7 to 8%, and you add a bit for leverage and you add a bit for development and a bit for the stock market volatility, 10 to 12% seems a reasonable number. And my view is that that is the cost of equity. If investors don't think they're going to get that, they'll sell the shares until they do. So they've had a pretty good run over the last 10 years. You know, globally, the number is about 13.5%. Asia has had some pretty good performance very recently, largely as a result of what's happened in Japan, but not entirely. And of course, Europe, as you might imagine, has lagged behind. I wish I had time to talk more about the US, which for me today is possibly the most interesting market. It's certainly the most transparent, possibly the best managed market in the world, and offers some pretty good growth in the near future, in my view. But just looking at the European property market, it hasn't done too badly compared to European equities. It's outperformed equities. It's obviously outperformed bonds. It had that huge run-up to June the 22nd, if I remember rightly, 2007. Quite why, I'm not sure, but I think it's something to do with enthusiasm about the introduction of REITs. Again, I'm not sure whether the performance of the South African market so far this year or in the last year has been to do with the expected introduction of REITs, possibly, but we had a correction, let's put it like that, to March the 9th, 2009, of quite dramatic proportions, and have recovered quite strongly since then. And looking at the major countries, the best performer, and these are all in local currencies, so I haven't made any adjustment for exchange rates here. Sweden has been the best performer. And this, I think, is no surprise. It's always been part of my philosophy that the biggest determinant of performance in the long run is the quality of management. And some of you may know that the Swedes had the biggest property crash of all time in the early 90s. Largely as a result of expanding abroad, becoming colonialists after a very strong run at home. And they came very badly unstuck, and the whole sector was completely wiped clean and new, and as it turned out, very good managers put in place. So it's no surprise that they have actually learnt the lessons of that crash, and management has been generally very successful. France comes along pretty well. This is influenced heavily by one particular stock. Unibail-Rodamco is about a third of the total French index, if not a little bit more, actually. And that is clearly, and I think everybody would agree, the best company in Europe. Big shopping center company, I think 57 different centers in 12 different European countries, quite apart from some Paris offices and convention centers. And the rest of them are pretty sad looking, especially the UK down there at not very much over the last 10 years, 3.7% in local currency. There are some lessons to be drawn from that, but I think in many respects it boils down again to quality of management. This looks at how the sector breaks down in terms of REITs versus non-REITs, first of all. We've got 30 stocks in the UK, 30 stocks in the UK, only half of which are REITs. Why is a company not a REIT? In the UK, it comes down to where they get their revenue from. You need to get 75% of your income from rent in order to qualify as a REIT, and there are a number of companies, 16 or so, who are developers to a greater extent than would allow them to qualify. In France, they're all REITs, and in Germany, yes, Germany. The Germans, for some reason, decided that residential investment companies could not be REITs. This is a mystery to many people. I think it's possibly because the private equity houses who were buying up big portfolios of German property 10 years ago, starting 10 years ago, were regarded as, they referred to them as locusts. And they didn't want them to benefit from whatever REIT classification would bring to them. So they decided that these guys would not be able to float as REITs on exit, which is a bit strange. And essentially, a lot of people, most people, when they're talking about REITs, are looking for yield. And compared to the US, or at least compared to US over time, yields are only about 3.5% in the US, but they're growing at 10% a year. We don't seem to get too much yield until you come to the Netherlands and Belgium. And this is because there's no growth in those countries. The dividend yield is that high because there is precious little growth. And I come on to something my compliance officer would be horrified by, a forecast for these REITs at the end of this presentation. But it basically shows that growth is very, very limited, which is why in these countries at least, where we have such high dividends. Right. Richard told me just now that he'd been looking at his emails this morning, and the GDP figures for the Eurozone for the first quarter had come out, and they were minus 0.3, was it? And for the Euro 27, that's also negative, but a little bit positive for the UK. and I think a little bit positive for some of the Nordic countries, but it's a pretty sad picture. The consensus forecast for 2013, as you can see, is a little bit negative. It looks pretty much in line with that. But going positive in 2014 and 2015, this is Henderson's figures, actually, but they're pretty close to consensus. I think that would be a good result to see 1% growth in the Eurozone next year, but we'll have to wait and see. What has improved, and this shows this is a little bit out of date, what has improved is the manufacturing Purchasing Managers Indicator of, I think PMI stands for, something like this, or index. In Germany and the UK, it's actually turned positive in the last month. So more than 50% of people are kind of seeing things as getting better. But again, this is just, could be just a flash in the pan. But sentiment is improving. I think how do you judge sentiment across the Eurozone? The Spanish government bond yield is one way of doing it. The Italian bond yield is another way of doing it. Oddly enough, when the Italians didn't have a government, the bond yield went down, which I think tells you what some people think about Italian governments. But people are saying positive things. You go back to July last year, and when Mario Draghi said he would do everything to protect the euro, and suddenly risk aversion became risk on, positive appetite. And the performance we've all seen in stock markets, at least, since then has been quite dramatic, especially in Asia. I'm going to talk a little bit about the UK now, the UK being the biggest part of our index, of our universe. And when we talk about the UK as a whole, the best way of looking at it is perhaps the IPD index. And the rolling 12-month total return, as you can see here, is pretty close to zero. When you consider that income is around about 5%, you're seeing some capital erosion as yields move out for the UK as a whole. But of course, the UK is doesn't include London. Well, it does include London, but London is not the UK, and London has seen a very different market. And this shows the capital value index of the London office market since the bottom in 2009. It's really been quite dramatic, down 45% and then a very sharp recovery. Not back to the peaks of 2007, but since, certainly very strong performance. And I'm going to talk a little bit about that. Offices aren't the only game in town. We, of course, have a very strong retail element in our universe in London. I don't mean just the shopping centres. Westfield has 2 of these big shopping centres that surround London, and half of the one that's going to be built in Croydon in the south, and Hammerson, the other half of the Croydon centre, has the big one, Brent Cross, in the north. I'm talking about central London retail, Bond Street, Oxford Street, and perhaps more fringe locations. But offices, first of all. If you go to London, you may say there are quite a lot of cranes, but in fact, they don't add up to a great deal of new supply of offices. And why is this? Well, obviously, demand is weak. But the supply of new office buildings that came on last year was very small compared to historical averages. 2013 is a bit better, with a little bit more in 2014 and 15. However, the stuff that's being built now is very little of it is speculative. And the buildings that are speculative in the City of London, we've got the walkie-talkie in Fenchurch Street, we've got the cheese grater. I don't know why they all give them these stupid names. But these are all being built by listed companies. It is not possible for people to raise development finance for speculative schemes. It just isn't there. Even the Middle Eastern owners of the Pinnacle in Bishopsgate have had to stop because they can't raise finance to complete the development. So the 2 that I referred to, walkie-talkie, is a combination of Land Securities and Canary Wharf, 2 big companies able to do it off their own balance sheet. The other one, cheese grater, that's right, is British Land, again, a very large company. And these things are, on average, about 50% let already and about a year to 18 months away from completion. Now, these aren't banks. Everybody can, you can easily imagine that the banks aren't hiring new people, therefore not taking new space. This is more to do with insurance companies, lawyers, and the more diversified tenant base of the City of London. So these latest figures from IPD look at the City and West End separately, and we've got sort of, 3, 4, 5, 6% annual rental growth forecast for the next 3 or 4 years, which is reasonably healthy given the current state of the economy and reflects a lack of supply, essentially. And this looks at the recovery of the London specialists. Now, the London specialists are not Land Securities, British Land, etc. They are 4 particular companies: Derwent London, Great Portland Estates, Shaftesbury. I haven't included the South Africans' favorite capital and counties in there because they don't have a track record going back that far. They were split from capital shopping centers, I would say, about 3 years ago. But they would have added positively to that performance, let's say. The fact that they're trading at a 50% premium to net asset value, which is nothing to some South African companies, of course, is a cause for some concern, let's put it that way. Right, I'm going to talk about retail. This is a very fiddly chart, I know. But we've got the retail specialists, Unibail-Rodamco over on the left, Into Properties, that for most of you will know that that is the old Capital Shopping Centres or Liberty International, but just the retail part over on the right-hand side. It shows which countries they're in. It shows how much they do in other sectors. So most of these are 100 or close to 100% retail. It's too difficult, because I can't see it, to go through all these numbers along the bottom. But just take Unibail-Rodamco. It's worth mentioning just the size of it relative to the others. Gross asset value of 30 billion euros, 82 shopping centers. I said 57 earlier on. That 57 are the ones with 6 million visitors or more a year. They have 82 in total. Quite low leverage, and certainly the cost of debt at 3.4% is the lowest in Europe. But I'm now going to talk a little bit about performance. I'm going to first of all look at this slide, actually, because this demonstrates 2 things. It demonstrates that there is quite a big difference between the performance of these companies. We've got the best of them, Unibail here, that has had sort of pretty strong, I think it's about 8% a year, like-for-like rental income growth over the last 7 or 8 years. And this is roughly the same as what we're forecasting for the next 3 to 4 years for Unibail, a clear, outstanding company. The only company that didn't see its like-for-like rental income grow during the crisis of 2008 and 9 was our favorite Into Properties. And I'd just like to go back to this slide, which looks at some of the characteristics of these portfolios. We've got here, in this column here, the average number of square meters per asset. Into Properties, nearly 100,000 square meters per asset. They have the biggest shopping centers. And some people say that the dominant shopping centers, the big dominant shopping centers, are the ones likely to outperform. Not in this case. And you could explain this by saying, well, where are these shopping centers? Are they in the right place? If you take Unibail-Rodamco, 60% of its floor space is in the top 50 European cities. Well, hardly any of Into Properties are in the top 50 cities. Whether it's Gateshead in the northeast, or Nottingham, or I can't remember the location of all the Into shopping centers. They're big, but they're not in the right place. I think the best thing you can say about the European retail sector, apart from Unibail-Rodamco, is that they've got a pretty good dividend yield. It's 5.1% on a simple average basis, excluding Unibail. And I think that's rather like a corporate bond. That's how to look at it. You're not going to get any growth in the next few years, but you have a pretty good dividend yield, and given what you get on bonds or cash or other less risky or, investments, 5.1% looks reasonably healthy. The Belgian dentist, the typical European investor, if you can put it that way, the Belgian dentist will buy that yield all day long, which gives a great deal of support to these share prices, despite the fact that we are looking here at NAV, negative NAV growth or falls in NAV over the next couple of years for at least these three bottom ones. How am I doing? 5 minutes. Just a little bit more about retail, and it may be the same thing here in South Africa, but it's certainly true in Europe and the States, that the market share of the bigger shopping centers is increasing all the time. And the way to read this chart is the number of trading locations on the bottom and the percentage of retail spend that those trading locations attract. And essentially what it's saying is that in 1971, 50% of retail sales took place in 200 trading locations, and in 2011, 50% of volume took place in only 90. So this just shows us that sales volumes are gravitating towards the biggest shopping centers. That is certainly true in the States as well. Looking at the performance of Simon Property Group, Taubman, General Growth, etc., versus the US retail market as a whole, it's clear. So if you pick the right assets, despite a weak retail environment, you can still make money. A little bit about Paris. Paris is a bigger office market than London, partly because there's far more government in France, and all of it's in Paris, but it's also by far the biggest city, as you know. I think basically what this says is that there is no rental growth in Paris. It doesn't say that, but I'm saying that. There is no rental growth in Paris. The CBD is stagnant. That's the heart of Paris here. Intramuros within the walls, and that darker bit there is the real golden triangle. It's hardly a triangle. With the peripheral office markets around here, there's a lot of construction going on. And especially in La Défense, the big high-rise area to the west of Paris, there are two big towers going up that show no sign of being let in the near future. And quite a lot of supply coming on stream. The great thing about Paris, however, is that the government is spending huge amounts of money on infrastructure, road, rail, underground, etc. The Grand Paris project, which is going to create a lot more viable office locations around Paris, relieving some of the congestion inside, which is, for an investor like us, a vital factor to take account of. But it really won't have any effect while I'm still working. It's a very long-term project. Prime office rents. I suppose this does actually show that there is, and whose numbers are these? CBREs. Well, I don't think they're right. I think that this is probably flattening out. Certainly in Q1, it didn't go up, and on the outside, on the periphery, it's going down. And this is a worldwide phenomenon, cost of money. This is one of the great supports, and I dare say it's going to be a subject of our panel discussion in a moment. You know, what is property? What is driving property values? Is it real demand? Is it rental growth? Or is it this low cost of money? The bond market has, to a great extent, taken the place of banks in lending to property for obvious reasons. In the States, I believe now that only 30% of the money borrowed by REITs, owed by REITs, is with banks. The rest of it is in the bond markets and also in insurance funds. So banks are clearly, and some people might welcome this, less important for real estate companies than they used to be. And just an illustration of some of the low costs. This is the most amazing one here. Unibail-Rodamco, a convertible, 750 million euros, paying a coupon of 75 basis points, and the strike price is at a 30% premium, or was at a 30% premium to the share price when they issued it, and it's got a 5-year life. So clearly people feel quite strongly about Unibail. And just some of these other numbers here. Basically, if you're a decent property company, you can borrow 7-8-year money at 3.5, maybe less in some cases, 2.75, up to Atrium, which is Eastern European shopping centers, at 4. This is an open market. Where are they trading relative to net asset value? This is based on numbers produced probably at the end of last year. So the NAVs are a little bit out of date, but the UK and Europe are both trading a little bit less than, or were then, less than net asset value. I think it's no longer true. Unibail, for instance, is trading at a 20% premium to net asset value. And the UK majors are trading a little bit above net asset value. The London specialists at 15 to 20% premiums. So the market has moved forward by about 20% since this chart was put together. And price to NAV growth. What stock markets are supposed to do is anticipate what's going to happen in the underlying property markets. So if investors think the rents are going up, then the stocks will trade at a premium. And the stock market has been quite good at that. There's only been one disconnect, as it illustrates here, during the tech bubble, when if you weren't TMT, nobody wanted to buy your shares, and certainly property suffered as a result, although the fundamentals were still quite healthy. But generally speaking, the price to net asset value of the shares has correctly anticipated what the net asset values of the companies are going to do. So what are they saying now, with stocks trading at smaller or larger premiums? They clearly think rental values are going to go up, NAVs are going to go up. I'm not too sure this time. Liquidity is the issue. As compared to North America and Asia, European stocks are very illiquid. This basically says how long it would take to liquidate your portfolio, and in order to get rid of all of it, you're looking at more than a month for Europe, whereas you could get rid of all of it in the other two regions rather more quickly than that. And that's really the key for any global fund. We've got about 10% of a global fund in Europe, largely as a result of illiquidity. And this is the last chart, and it's not very penetrable, I'm afraid, but basically it says that the total return from the index we expect to be 6.8%, which is pretty subpar. If you expect 10 to 12% a year in the long run, this next 12-month period is not going to be exactly what you want. The income is going to be 4%, which is reasonably healthy. Now, the repricing, that's the change in the price or the value that the stock market places on these shares, is always the most difficult one to predict, and it's always the biggest number. So we're forecasting no change in the valuation, or a slight depreciation of the pricing. So that hardly has an effect. We'll be wrong about that number. But what we have a reasonable confidence in is the growth in net asset value at 3.4%, which is subpar, as I said. But in the meantime, we get this dividend yield of 4, which is the best we can say for it. Okay. Well, I think Richard is now going to return to the stage.
Thank you.
Congratulate me on precisely 30 minutes, 25. Thank you.
Please have a seat at the far end.